Picture a hospital heart monitor, green line, black background, beep, beep, beep. It is steady, it is rhythmic. It is the very picture of health. Now, imagine that same monitor draws a flat line not because the patient is stable, but because the sensors are being jammed. This is the paradox of the financial markets in late 2025. If you look at the VIX, the so-called fear gauge, it is asleep. If you look at the daily closes of the S&P 500, they appear remarkably orderly. But if you put your ear to the ground and listen to the plumbing of the system, you do not hear a steady hum. You hear the screeching of metal on metal. The market is not calm. The market is clenched. Welcome to the era of artificial stability. To understand why the ground beneath us feels so solid right before it cracks, we have to talk about the single biggest structural shift in modern financial history. It is a change that did not happen on the front page of the Wall Street Journal, but in the dark, fiber-optic trenches of high-frequency trading. It is called the zero-day to expiration option, or, in the parlance of the trading desk, 0DTE. Historically, options were insurance. Farmers used them to protect against a bad harvest. Portfolio managers used them to hedge against a crash next month. They were assets with a shelf life weeks, months, sometimes years. They allowed time for a thesis to play out. But in 2025, time has been removed from the equation. By May of this year, a staggering statistic crossed the wires, one that should have set off alarm bells in every regulatory office in Washington. Zero-day options now account for over 61% of all volume in the S&P 500. Think about that for a second. Nearly two-thirds of the activity in the world's most important equity index is not investing. It isn't even trading in the traditional sense. It is a bet placed at 9:30 inches the morning on where the price will be at 4:0 inches the afternoon. These are financial instruments with the lifespan of a mayfly. They are born, they trade, and they die, all within a 6.5-hour window. So, why does this create a phantom calm? Why doesn't this massive gambling parlor create chaos? Here is the mechanism, and it is crucial that you understand this. When you buy a lottery ticket, someone has to sell it to you. In the stock market, that someone is usually a market maker, a sophisticated algorithmic firm whose only job is to provide liquidity. When millions of retail traders and aggressive hedge funds buy these zero-DTE options, the market makers take the other side of the trade. But here is the catch. The market maker does not want to gamble. They want to be neutral. They want to capture the spread and go home flat. So, if the public buys calls betting the market will go up, the market maker sells those calls. To hedge their risk, the market maker must buy the underlying stock. This pushes the market up. But as the market rises, the market maker's exposure changes, forcing them to sell a little bit to stay balanced. This dynamic creates a feedback loop of mean reversion. It acts like a giant, invisible rubber band. If the price drops too remarkably, the hedging flows pull it back up. If it rallies too hard, the hedging flows smack it back down. The result is a market that looks tranquil, a market that stays within a tight range, a market that feels safe. But this stability is not organic, it is manufactured. It is the result of trillions of dollars of hedging flows fighting each other to a standstill every single day. We are not standing on solid ground. We are standing on a pressurized container. And the pressure gauge has a specific time of day, 3:30 p.m. Eastern Standard Time. In 2025, we have observed a peculiar phenomenon. For the first 6 hours of the trading day, volatility is practically dead. But in the final 30 minutes, the gamma window, the volume explodes. This is where the physics of the market begin to warp. As these zero-day options tick down to their final seconds of life, their sensitivity to price changes, their gamma goes vertical. A 1-point move in the S&P 500 can instantly turn a losing option into a winner or a winning option into dust. Market makers are forced to sustain this violent oscillation, buying and selling billions of dollars of stock in milliseconds to hedge positions that are about to vanish. It is a daily game of musical chairs played with nuclear weapons. The danger of this structure is what we call pin risk, or the gamma trap. As long as the flows are balanced buyers roughly equal to sellers, the market stays pinned. It levitates. But what happens on the day when the flows are strictly one-sided? Imagine a geopolitical shock hits the news wire at 2 p.m. Suddenly, everyone rushes to buy put options betting on a crash. The market makers sell those puts. To hedge, they must short the market. As the market falls, they must short more. In the old days, options expired next month, so the dealers had weeks to adjust. In the zero DTE world, they have minutes. They have to dump everything now. The rubber band that was keeping the market stable snaps. The feedback loop that dampened volatility suddenly reverses and amplifies it. The artificial stability transforms instantly into a liquidity cascade. We have seen glimpses of this before. We saw it in the Volmageddon of 2018. We saw it in the flash crash of 2010. But in 2025, the scale is logarithmic compared to those events. We have built a machine that is designed to suppress volatility right up until the moment it destroys it. This is why the VIX is lying to you. The VIX measures the price of options that expire in 30 days. But nobody is trading the 30-day options anymore. The risk has migrated. It is hiding in the intraday shadow, in the zero-day dark pools where the algorithms fight for pennies. The scary part isn't that the market is gambling. The market has always been a casino. The scary part is that the structural plumbing of the exchange itself has become dependent on the flow of these bets to maintain the illusion of order. We are picking up pennies in front of a steamroller, and in 2025, the steamroller is moving faster, and the pennies are getting shinier. But to truly understand how we convinced ourselves that we could mathematically conquer risk, that we could engineer a world where stocks only go up and volatility is obsolete, we have to go back. We have to leave the fiber optic cables of 2025 and travel back to a dusty chalkboard in New Jersey in the mid-20th century. We need to look at the moment when a group of geniuses decided that the randomness of the universe could be tamed by a simple equation. Because before there was zero DTE, before there was high-frequency trading, and before there was the Black-Scholes model, there was a man at Bell Labs who thought he had figured out the ultimate betting system. And he was right, until he wasn't. Also, strictly speaking, he wasn't just wrong. He was mathematically eliminated. And that is the terrifying nuance of financial ruin. You can be right 99 times in a row. You can be the smartest person in the room. You can have a model that predicts the movement of the sun and the stars. But if your sizing is wrong, the math of the 100th time will still erase you from existence. This is not a new mistake. This is not a product of AI trading or the 2025 liquidity crisis. This is a ghost story that mathematicians have been whispering to each other for 300 years. It is the street. Petersburg Paradox relived. To understand why the global financial system is currently teetering on a razor's edge, we have to endure a brief moment of time travel. We need to leave the high-frequency trading servers of modern New York and transport ourselves back to 1956. Picture Murray Hill, New Jersey, a sprawling, brick industrial complex surrounded by manicured lawns. This is Bell Labs. At this specific moment in history, it is arguably the most intellectually dense square mile on planet Earth. This is where the transistor was born. This is where the laser was theorized. And walking these corridors is a man named Claude Shannon, the father of the information age. But Shannon isn't working on computers today. He is in a smoke-filled room with a physicist named John Larry Kelly Jr., and they are talking about gambling. Specifically, they are looking at a problem that had baffled economists since the 1700s, the Street Petersburg Paradox. Here is the setup. Imagine I offer you a game. I will toss a fair coin. If it comes up heads, I give you $2. If it comes up heads again, I give you $4. Then 8. Then 16. I will keep doubling the payout until the coin finally lands on tails. Now, here is the question. How much would you pay me to play this game? If you ask a standard economist using expected value, the average outcome the answer is, You should pay everything you have. You should sell your house, your car, and your clothes to play this game. Why? Because mathematically, the expected average payout is infinite. There is a small chance you flip heads 20 times in a row and become a billionaire. The average of all possible futures is infinite wealth. But you wouldn't do that, would you? You know instinctively that paying your life savings for a coin toss is insanity. This is where John Kelly changed the world. In 1956, he published a paper with a deceptively boring title, A New Interpretation of Information Rate. In it, he proved that expected value, the average, is a lie. Kelly realized that we do not live in the average of a billion parallel universes. We live in one single timeline. We live in a world of geometric pounding, not arithmetic averages. If you play a game where you have a 50% chance of gaining 50% and a 50% chance of losing 40%, the average says you make money. But if you play that game repeatedly, you will eventually go broke. The drawdowns kill you faster than the gains can save you. This leads us to the most dangerous number in finance and the specific mechanism that broke the market in 2025. Consider a bet with a 99% win rate. 99 times out of 100, you double your money. 1 time out of 100, you lose it all. If you are a Wall Street algorithm optimizing for expected value, this looks like the greatest trade in history. The average return is astronomical. It looks like free money, a money printer. So, what do? You bet everything. Round 1, you win. You double your money. You feel like a genius. Round 2, you win again. You are now the master of the universe. Round 10, round 20, round 50. You are compounding wealth at a rate that makes kings jealous. But you have a fatal flaw. You are betting 100% of your capital because the odds are so good. Eventually, the 100th round arrives. It is inevitable. It is a statistical certainty. You flip the coin, you lose. And because you bet everything, your bankroll goes to zero. This is the cruelty of zero. Zero has a gravity that is inescapable. Once you multiply your wealth by zero, it doesn't matter that you were right 99 times before. You are done. You cannot play again. John Kelly proved that to survive, you must optimize for the geometric mean, not the average. You must size your bets so that you can never, ever hit zero. Even if the odds are 99 to 1 in your favor, you must keep a reserve. Now, let's bring this back to the present day. Why does this matter in 2025? Because for the last 15 years, the entire global financial system has been playing the Street Petersburg game. But they added a twist. They are not just betting their own money. They are using leverage. When a hedge fund borrows $50 for every $1 of cash they have, they are effectively doing exactly what John Kelly warned against. They are betting more than 100% of their survival capital on a trade that they believe has a 99% win rate. They look at the bond market. They see the Federal Reserve guaranteeing stability. They see the green line on the heart monitor that we discussed in the first chapter. They calculate that the risk of a crash is less than 1%. So they lever up. They bet the house. They bet your pension. And on the surface, it works. For years, it looks like they are printing money out of thin air. They post record profits. They buy the Hamptons houses. They tell you that risk has been managed. But they have confused stability with delayed volatility. In the 1956 card room at Bell Labs, Kelly knew that if you bet too big, you don't just lose. You experience gambler's ruin. The system doesn't just decline, it snaps. The market used to have small corrections, little losses that kept the bet sizing honest, but we haven't allowed a real correction in years. We have jammed the sensors. We have forced the win rate to 99% artificially. This forced the optimal bet size, according to their flawed models, to rise to infinity. Everyone is all in. The leverage is maxed out. They are picking up pennies in front of a steamroller, but they have convinced themselves the steamroller has been abolished by the central bank. They forgot the lesson of the physicist. They forgot that the probability of a rare event occurring over a long enough timeline is not a probability. It is a certainty. And when everyone is betting 100% of the system on a 99% outcome, the moment that 1% event arrives, we don't get a market correction. We get a deletion event. We get what happens when you erase the line between investment and gambling, and then rig the table so nobody knows the true odds. But to execute this strategy, to bet the entire house on a fraction of a penny, you need a mechanism to hide the risk. You need a way to make the dangerous look boring. You need a process that takes radioactive financial waste and repackages it as a pristine AAA asset. That mechanism exists. It is the engine room of the current crisis. It is a process called volatility laundering. It sounds like a crime involving offshore accounts, shell companies, and bags of unmarked bills. But in the financial landscape of 2025, it is something far more sophisticated and, frankly, far more dangerous. It is not a crime against the law. It is a crime against mathematics. To understand why this matters, we have to look back at the logic we just established. We know that to survive the Bell Labs betting system, the Kelly criterion, you must protect your bankroll. We know that volatility is the enemy of compounding. If an asset drops 50%, you need a 1 to 100% gain just to get back to zero. This is called variance drag. It is the mathematical friction that eats away at wealth in choppy markets. In a truthful market, you avoid variance drag by finding stable assets. But in the modern financial system, Wall Street realized it was easier to simply delete the evidence of the variance. They stopped trying to tame the ocean, and instead, they just rigged the tide gauge to always show calm waters. This is the engine of the private equity and private credit boom that consumed the early 2020s. Here is how the magic trick works. If you buy a stock like Apple or Nvidia, the price changes every microsecond. You see the fear, you see the panic, you see the euphoria. It is liquid, it is real, and it is volatile. But if you buy a stake in a private company, or a loan in a private credit fund, there is no ticker symbol. There is no frantic screen. Instead, the price of that asset is decided perhaps once a quarter, often by a committee sitting in a quiet conference room. They use models. They use discretionary adjustments. And miraculously, when the public stock market is screaming in agony, crashing 20% in a month, these private assets often report that they are flat. Or better yet, up 1%. Cliff Asness, the quant legend, coined the term volatility laundering for this exact phenomenon. He pointed out that the industry wasn't actually generating better risk-adjusted returns. They were simply refusing to mark their assets down when the market crashed. They were selling the illusion of safety. By the third quarter of 2025, this illusion had become a structural liability for the global economy. Let's look at the data from that period. In late 2025, public bond indices were experiencing violent swings. Inflation data was erratic, central banks were twitching, and the liquid markets were pricing in massive risk. If you looked at a chart of the Bloomberg Global Aggregate Bond Index, it looked like a seismograph during an earthquake. But if you looked at the net asset values, the NAVs of the major private credit funds, the line was smooth, it was serene, it was an escalator gently rising to heaven. This gap, the divergence between public reality and private fantasy, became known as the valuation gap. And it wasn't just a few percentage points. We are talking about a disconnect so large that the UK Financial Conduct Authority, the FCA, had to step in. In late 2025, the FCA issued a stark warning regarding valuations in private markets, specifically targeting the fair value assessments under their new consumer duty rules. They realized that pension funds and retirees were pouring billions into these private assets because they looked like safe havens. But they only looked safe because they weren't being updated. It creates a scenario that reminds me of Wile E. Coyote running off a cliff. He doesn't fall immediately. He hovers in midair. He is fine. He is stable until he looks down. Volatility laundering essentially allows the coyote to never look down. But why is this a systemic risk? Why isn't it just a victimless accounting trick? Because of leverage. Remember the heart monitor from Chapter 1, The green line that was jammed, this is it. When volatility is artificially suppressed, algorithms and risk models read that silence as an invitation to increase leverage. Banks look at a private equity portfolio, see a smooth, low volatility line, and say, this is safe. We can lend massive amounts of money against this. So they do. They pile debt onto these assets. This creates a hidden fragility. If those assets were marked to market, if they reflected the true chaos of the 2025 economy, the lenders would have issued margin calls months ago. The leverage would have been flushed out. It would have been painful, but it would have been healthy. Instead, the volatility laundering suppressed the signal. It allowed the pressure to build up behind the dam, undetected. We saw a crack in the facade in August 2025, specifically in London. While the private funds were claiming everything was fine, the publicly traded vehicles that hold these private assets, listed private equity funds, started to plummet. The market was essentially saying, we know your portfolio isn't worth what you say it is. The shares of these funds traded at massive discounts to their claimed net asset value. That discount was the market screaming the truth. It was the market saying, you are lying. But the managers held firm. They kept the marks high. They kept the fees flowing. They kept the variance drag hidden in the footnotes. This brings us to the psychological element of this crisis. Investors wanted to be lied to. If you are a pension fund manager in 2025 and you need an 8% return to pay your retirees, you have two choices. You can buy public stocks and endure the stomach-churning volatility of a chaotic world, explaining every quarterly loss to your angry board of directors. Or, you can buy a private credit fund that smooths out the bumps, sends you a nice steady report every quarter, and lets you sleep at night. You choose the lie. You choose the laundered volatility. It feels like survival. It follows the Kelly criterion of protecting the bankroll, but only on paper. This creates an economy that is deeply bifurcated. On the surface, in the private markets, there is an eerie calm, a simulated stability, but underneath, the variance drag is still there. Risk cannot be destroyed, it can only be transferred. By hiding the volatility, they didn't get rid of it. They transformed it from market risk prices, moving up and down, into tail risk. Tail risk is the risk of a total, sudden collapse. Think of it like a beach ball held underwater. It takes effort to hold it down. The deeper you push it, the more you suppress the natural volatility of the market, the more potential energy you build up. The volatility laundering of 2024 and 2025 pushed that beach ball down to the bottom of the Mariana Trench. And the irony is, this fake stability, this artificial calmness, is exactly what attracted the next group of actors in our story. You see, if you convince the world that prices will never move, that the spread between assets will never change, you invite a very specific type of gambler. You invite the arbitrageurs, the ones who pick up pennies in front of steamrollers. They looked at this frozen, laundered market and saw an opportunity to exploit the tiny microscopic differences between the price of cash and the price of futures. They built a machine to harvest these discrepancies, believing that the volatility would never return. But the beach ball was about to slip from the industry's grasp. But to understand why it slipped, and why the resulting explosion was inevitable, you have to look at the hand that was holding it. It was not the hand of a reckless gambler betting on meme stocks or cryptocurrency. It was the steady, manicured hand of the institutional bond market. The mechanism that finally broke the financial stability of late 2025 is known as the basis trade. If you walked into a major hedge fund in New York or London during the quiet months of early 2025, you would not have seen panic. You would have seen a machine functioning exactly as it was designed. You would have seen traders buying US Treasuries, the safest asset on planet Earth, and simultaneously selling Treasury futures. On the surface, this looks like a wash. You own the asset, and you have agreed to sell the asset at a future date. Where is the profit? The profit lies in the gap. The spread, the tiny, microscopic difference in price between the cash bond you hold in your hand and the futures contract that tracks it. Usually, the futures contract trades at a slight premium to the cash bond. A logical market assumes that if you hold the bond, you should be compensated for the cost of financing it. But in the distorted reality of 2025, that gap became a gold mine. Hedge funds realized they could exploit this discrepancy. They could buy the cash bond, short the future, and pocket the difference when the prices eventually converged at expiration. It is free money. It is a risk-free arbitrage. It is the perfect trade. There is just one problem. The profit on this trade is measured in basis points. 1 basis point is 1/100th of 1%. We are talking about picking up pennies. If you invest $1 million into this trade, you might make enough to buy a modest lunch. It is hardly worth the effort. So, how do you turn a boring, low-yield arbitrage into the most profitable engine on Wall Street? You do not use your own money, you borrow. And you do not just borrow a little. You borrow staggering, eye-watering amounts of cash to supercharge the trade. This is where the street Petersburg Paradox comes into play. In probability theory, the street Petersburg game represents a scenario where the expected payoff of a game is infinite, yet no rational person would pay a high price to enter it because the risk of a long run of bad luck, however unlikely, wipes you out before you reach that infinity. The hedge funds of 2025 ignored the paradox. They looked at the basis trade and saw a coin that had landed on heads for 20 years. They decided to bet the house. By the second quarter of 2025, the volume of these leveraged swap bets had surged to $631 billion. That is a doubling of the exposure in barely 15 months. To put that number in perspective, that is larger than the GDP of most European nations, all riding on a single mathematical assumption, that the price of a treasury bond and its future contract would always converge smoothly. They were leveraging these trades 40, 50, sometimes 60 times over. For every dollar of actual investor capital in the account, they were borrowing $50 from the repo market, the overnight lending system that acts as the plumbing for the global financial system. Why does this matter to you? Why should you care if a hedge fund over-leverages itself on bond spreads? Because the collateral they used to borrow that money was the US Treasury bond itself. The foundation of the entire global economic system, the asset that backs the US dollar, your pension, and the banking system was being used as a poker chip in a $600 billion game of leverage. The boring safety of the bond market was an illusion. Underneath the surface, the bedrock had been turned into quicksand. The Bank of England saw this coming. In their late 2025 financial stability report, they issued a stark warning. They pointed out that this specific trade had become so large and the leverage so tight that any sudden spike in volatility would not just hurt the hedge funds, it would force them to sell. And this is the mechanism of the crash. It involves a concept called the gamma squeeze. Imagine the market moves against you by just 1%. In a normal investment, you lose 1%. Irritating, but manageable. But when you are leveraged 50 to 1, a 1% move against you wipes out 50% of your equity. Instantly. Your lender, the repo desk at a major bank, sees this drop. They do not care about your long-term strategy. They do not care that the prices will eventually converge. They care that their collateral is dropping in value. So they issue a margin call. They demand cash, today, now. To get that cash, the hedge fund has no choice. They cannot sell the futures contract easily. They have to sell the liquid asset. They have to sell the US Treasury bonds. When they sell billions of dollars of treasuries into a falling market, the price of treasuries drops further. This creates a feedback loop. The price drop triggers more margin calls at other hedge funds. They are forced to sell too. Suddenly, the risk-free trade becomes a suicide pact. We saw a preview of this in March 2020. We saw the treasury market go no bid, meaning you could try to sell the safest asset in the world, and there was simply nobody on the other end of the phone to buy it. The Federal Reserve had to step in and print trillions of dollars to act as the buyer of last resort. But, in late 2025, the context was different. Inflation was already sticky. The Federal Reserve was trying to tighten its belt, not loosen it. They had promised to stop the printing press. They had promised to normalize the balance sheet. The hedge funds were betting that the Fed was bluffing. They were playing a game of chicken with the central bank. They loaded up the boat with $600 billion of leverage, effectively saying to the government, "If we go down, we take the bond market with us. You have to save us." It relies on the assumption that liquidity is like air, always there, invisible, and free. But liquidity is not air. Liquidity is confidence. And confidence is fragile. The BIS, the Bank for International Settlements, essentially the central bank for central banks, flagged this concentration of short Treasury futures as a systemic bomb. They noted that the short position in the futures market had become so massive that if those traders ever had to buy back their contracts to cover their positions, the rush for the exit would look like a fire in a crowded theater with only one door. This is the essence of picking up pennies in front of a steamroller. The traders focus entirely on the pennies. They build complex algorithms to find more pennies. They optimize their leverage to pick up the pennies faster. They hire PhDs in physics and mathematics to model the distribution of the pennies. But they never look up to see how fast the steamroller is moving. In 2025, the steamroller was interest rate volatility. The one thing that the basis trade cannot handle is a world where rates move quickly. If rates stay flat, the spread stays stable, and the machine prints money. But as we move toward the end of the year, the geopolitical fractures we discussed in Chapter 1 began to widen. Supply chains snagged, energy prices spiked. Inflation, which was supposed to be dead, twitched back to life. The bond market reacted. Yields began to jump. The volatility index for treasuries, the MOVE index, started to climb. For the basis trade, this was the smell of smoke. The spread between the cash bond and the future started to wobble. It became erratic. The correlation broke down. And when you are leveraged 50 times over, erratic is a death sentence. The margin calls began as a trickle in November. Just a few email notifications to risk managers, a polite request to post a few $1 million in extra collateral. Nothing to worry about. Standard procedure. But the geometry of compounding works in reverse, too. A loss on a leveraged portfolio does not move linearly. It moves exponentially. As the funds sold bonds to meet margin calls, they depressed the price of the bonds, which increased the yields, which increased the volatility, which triggered more margin calls. The steamroller was no longer looming in the distance. It was accelerating. The tragedy of this moment is that the mathematics were public. The leverage data was in the BIS reports. The exposure was visible in the CFTC commitment of traders' reports. Everyone could see the pile of dynamite. But the incentives of the financial system rewarded the people lighting matches. They believed they could get out in time. They believed they were smarter than the room. They believed, fundamentally, that the Federal Reserve would never let the Treasury market break. They treated the central bank not as a regulator, but as an insurance policy. They were about to find out that insurance policies have deductibles. And sometimes, the deductible is your entire existence. This massive accumulation of leverage, hidden in the plumbing of the repo market, set the stage for the next phase of the crisis. It turned a structural weakness into a kinetic failure. But to understand the speed at which it unraveled, we need to understand the force that multiplies all financial errors. We need to leave the trading floor and enter the realm of pure mathematics. Because once the selling started, it wasn't fear that drove the market down. It was geometry. That sounds abstract, doesn't it? It sounds like something you leave behind in a high school classroom. But in the wreckage of the 2025 financial correction, geometry was the difference between solvency and annihilation. To understand why the smart money evaporated, why algorithms designed by PhDs in physics marched their funds off a cliff, we have to confront a lie that has been sold to you for your entire investing life. It is a lie embedded in every brochure, every pension fund projection, and every financial news segment. The lie is average return. Wall Street speaks to you in the language of arithmetic. They tell you design fictions like, the S&P 500 returns 10% on average. They show you a straight line moving up and to the right. But you do not eat arithmetic returns. You do not pay your mortgage with averages. You live and you invest in a world of geometric returns. And in geometry, the path you take matters more than the destination you were promised. Let's look at the mechanism that destroyed the basis trade gamblers we discussed in the last chapter. They were chasing yield, but in doing so, they ignored the volatility tax. Here is the math they forgot. And I want you to visualize this clearly, because it explains why your portfolio feels stagnant even when the news says the market is doing well. Imagine you have $100. In year 1, you make a 50% return. You now have $150. You feel like a genius. In year 2, you take a 50% loss. Now, basic arithmetic, the kind taught to you by financial advisors, says plus 50 minus 50. The average is 0. You broke even. But geometry is cruel. 50% of $150 is $75. If you subtract 75 from 150, you are left with $75. You started with 100, you ended with 75. You lost 25% of your wealth. How is this possible? Your average return was 0%, but your geometric return, your real money, bled out. Where did that money go? It didn't vanish into the ether. It was consumed by a mathematical force known as variance drag. This is the hidden gravity of finance. We can actually quantify it with a formula that should be tattooed on the arm of every risk manager in New York. Realized return equals average return minus half of the variance. Read that again. Minus half the variance. This means that volatility is not just risk or fluctuation or a bumpy ride. Volatility is a fee. It is a mathematical penalty deducted from your compounding. The more your portfolio swings wildly up 20% one month, down 20% the next, the more of this tax you pay to the gods of geometry. The volatility launderers of the early 2020s, the firms running those basis trades and selling zero-day options, thought they had cheated this law. By artificially suppressing volatility, by keeping the line on the chart smooth, they believed they had repealed the variance drag. They thought they entered a world of pure arithmetic, where they could leverage up 10, 20, 50 times, collecting pennies, believing the variance term was 0. But nature abhors a straight line. When the beach balls slipped from their hands, volatility didn't just return, it spiked. And when variance spikes, the formula executes its judgment. If you have a massive leverage ratio, and the market moves against you by even 4%, you aren't looking at a drawdown. You are looking at the absorbing barrier. That is the technical term for a zero. And this brings us to the most important concept of this entire series, the difference between wealth creation and survival. In arithmetic, a loss can be recovered. If you lose $10, you just need to make $10 back. In geometry, losses are non-linear. If you lose 10%, you need an 11% gain to get back to even. Manageable. If you lose 25%, you need a 33% gain. Painful, but possible. If you lose 50%, which is what happened to many aggressive growth portfolios in the initial washout, you need a 100% gain just to get back to where you started. And if you lose 90%, you need a 900% gain. You are dead. This is the grim reality of the recovery trap. The deeper the hole, the steeper the walls become. The great deception of the modern financial industry is pushing you into high-variance strategies, crypto speculation, highly leveraged tech stocks, short-term option gambling, all under the guise of chasing growth. They are selling you the upside of the arithmetic mean, while hiding the downside of the geometric drag. They want you to focus on the ceiling, while variance is sawing through the floor. The investigative historian sees this pattern repeating for centuries. From the tulip mania of the 1600s, to the South Sea bubble, to the 2025 liquidity crunch. The players change, but the math does not. The winners in the long run are never the ones who made the highest annual return in a single lucky year. The winners are the ones who minimized the variance drag. They are the ones who understood that the first rule of compounding is never interrupt it unnecessarily. So, as we look at the ruins of the strategies we just dismantled, volatility laundering, the basis trade, the zero DTE casino, we see they all shared a fatal flaw. They were optimized for a world where risk was additive. They treated the market like a coin toss where you could just keep playing. But the market is not a coin toss. It is a game of Russian roulette. In Russian roulette, the average outcome is that you survive and keep the money. But the geometric reality is that once you hit the bullet, you don't get to play the next round. The probability of ruin is not a statistic to be managed. It is a cliff edge to be avoided at all costs. This brings us to the shift, the pivot point in our documentary. We have spent 4 chapters diagnosing the disease, the fake liquidity, the hidden leverage, the structural fragility. Now, we must look at the cure. Because if you cannot trust the volatility numbers on your screen, and if the variance drag is silently eating your wealth, how do you position yourself for the year 2026? You stop trying to be the smartest person in the room. You stop trying to predict the unpredictable. Instead, you focus on the only goal that matters in a geometric world, eliminating the zero. You have to construct a portfolio that is robust not to the average day, but to the worst day. You have to move from fragile to robust to something else, something that actually benefits from the chaos. But to do that, you have to do something that feels counterintuitive. You have to be willing to lose small, over and over again, in exchange for never losing big. You have to think like a venture capitalist of the apocalypse. Because while the bond market was burning, and while the tech bros were being liquidated, there was a small group of investors who didn't just survive, they thrived. They didn't predict the crash. They simply owned the insurance that the rest of the market had sold to fund their reckless gambling. They understood the geometry, and because they respected the math rewarded them. Let's find out how they did it.